Good morning, everybody. Kirk Spano, Retirement Income Options and Stocks of the Week, February 7th, 2022. And what great American was born on this date in 1970? This guy. So there you go. Happy birthday to me. I am orbiting the sun now, starting my 53rd orbit, 52 years old, so going on the 53rd orbit. And I will tell you, I can't tell the difference. It's a little warmer. That's all I know. So anyway, I promised that I would focus on dividend paying stocks to sell puts on so that we can start to expand that part of our portfolio. I am going to give you a few stocks that are on the very short list, which is our broader watch list, and I'll give you the reasons why I like these. And then some of them are actually on the plug and play, which are our focus list. In general, you want to focus on the focus list, but I think that the ones that I have here from the VSL, I think are probably worth doing too. So we're going to start with AT&T, but I want to do a primer on some Elliott Wave and how it incorporates with what we're doing first. So this is Liberty Sirius, and this is a stock that I put us on to about 2 years ago because I believe that Sirius Satellite, with its incorporation of Pandora to become a global app and not just be a US focused company, was going to really take off. It's being installed in over 80% of all new cars now. So there's a lot of revenue potential. And if you examine your own behavior, including me examining mine, what I have found is that it's really hard not to justify paying $7, $8, $9, even $15 a month for a streaming service that you like. And even though we're driving less, now that Sirius isn't tied to your car, it just happens to be there. You can run it on Bluetooth through any device using the app on your television. It really is an anywhere app now from your phone. You can use it. And I think there's a ton of upside. Plus, I like the two biggest investors here, which are Liberty and Berkshire Hathaway. So you got Warren Buffett and Malone, who are loaded up on this. And of course, the Liberty stocks have been spectacular performers historically. If you go way back to the merger with Sirius, when essentially Liberty took over Sirius, see the stock rallied pretty good here. The one stock you really want to take a look at, though, is Sirius. Sirius, of course, went from almost nothing to much higher. So about a sevenfold gain here in the last decade. Fell off, bottomed in the financial crisis, and just kept on running. And now it's been chopping for a few years, which I think makes this very interesting on the pullback. You see, it formed a very easy to see Elliott Wave pattern. Here's your trend line, catches here, tests it there. So you have your first wave up, retrace, second wave up, retrace, then finishes your 5-wave up pattern, and now is in a corrective pattern, which I think probably ends in the spring sometime with a low. The rules are that it shouldn't go below here. So a low around 42. Probably pull this down just a touch, which is right on the long-term trend line, demand line. Below this line means that there's generally interest developing. Above the line means it needs to break out to keep going up. So it's going to finish right on the red line, which is interesting. That's peak demand, right? Peak demand and peak supply. And one of the things that we know about this particular stock is that Warren Buffett loves it. And every time it dips, he buys it. So they were buying it at the trend line every time. It got through this time. I think that they were buyers here. I believe I saw a filing for that. And if it comes back down on general market weakness, I think you're going to want to buy it here. And again, this is just a very classic look. 5 waves up, 3 waves down, and then probably 5 waves up. My 5-year price target is about $200. So from a price in the 40s to about 200, you're looking at a potential 5-bagger. And that's if just really the expected things happen on their global growth. If this ends up being even more popular, if they can find a personality or 2 or 3 that really strike a chord overseas, which I think they will, I think that this could go way higher than 200 if they really succeed. But I showed you this not only because of the story, but because look at how just this is just as easy as it gets to chart an Elliott Wave. And I can say that because I don't chart Elliott Wave a lot. I just kind of eyeball it. And this one I was able to say, wow, this is pretty straightforward. So on top of the quantitative factors over here, your technical indicators down here, your Elliott Wave, all those things together on top of the fundamental story make this one pretty easy to trade. So if we get down into the middle to lower 40s, either selling cash secured puts, which they're not yielding a lot of premium, because I think that everybody knows Buffett is buying this, but just buying the stock is probably a pretty good idea. So if you didn't buy it down here in the 30s with me, I think you get a chance in the 40s again, and I think you'll appreciate that. So now let's go on to our main topic, which is, I promised, dividend stocks that you can sell cash secured puts on. We're going to actually first shoot over to covered calls. We had a gigantic batch of covered calls that we sold in December, which are all pretty much expiring or getting called away, but most of them are expiring because of the January correction, because most of the calls we wrote were January or February. And you can see that there's not a lot in the S&P 500. And this is what I call the VSL Plus. This is the very short list plus about another 60 or 70 stocks that I follow just to keep an eye on, like Exxon, right? I don't think I'll ever buy Exxon or Chevron. We'll see. I can change my mind, though. If these companies really start to get greener, there's an argument for that. However, most of the overbought are concentrated in energy. And one of the lessons I've learned, and if you listen to Raul Powell, what you find is that selling energy stocks into a perceived energy shortage is usually a pretty good strategy. So I sold my energy stocks as they were spiking in 2007, and then I sold them again in 2014 because I saw the writing, and I wrote articles about this, saw the writing on the wall for Saudi Arabia to flood the market with oil. So you're going to want to keep an eye on all these: Exxon, Chevron, EOG, Marathon, Pioneer, Occidental. I saw somebody really unload a lot of Occidental recently. Suncor, Diamondback. These are all stocks that soon you probably want to sell covered calls on, maybe going into summer. But I don't know that it would hurt you to sell covered calls on these now in case we just get general market weakness. And remember, I've mentioned this a couple of times, Exxon and Chevron are going to add 800,000 to 900,000 barrels of oil a day to the market by winter, by about a year from now. And there's a lot of uptick in drilling in the Permian as well from companies like Pioneer and EOG. And they're going to add another 300,000, 400,000, 500,000 barrels a day. So by this time next year, 1.2, 1.3 million barrels a day of extra oil on the market. That's addition to probably another 1 to 2 million barrels a day from OPEC and any cheating that's coming. Because as EVs hit the market, and we already know that oil is having lower and lower and lower growth rates, under 1%, when you average it out over 5 years. It went way down, then it popped up, but the average is about 1%. As EVs hit the market, oil demand will actually start to get closer to zero, and then probably towards the end of the decade, it's negative. So you'll have negative demand growth. You'll have demand destruction by the end of the decade. Well, all these OPEC countries, as well as your big producers like Exxon and Chevron, they know that the demand destruction is coming. I've showed you the charts that BP has put out. They're all going to drill, baby, drill, because they don't want stranded assets. And the last man standing in oil is going to be Saudi Aramco. There's just no doubt about it. And the United Arab Emirates, which you can't really buy into, will be second. So if you really want to own an oil stock, when Saudi Aramco puts more on the market here soon, which they've announced, buy Saudi Aramco. Dividend, and it's a stock that they need the price to go up on because it's funding their other projects in their Vision 2030 plan. So if I had to own one oil stock in the whole world, I think it's probably Saudi Aramco. Although I think there's an argument to be made for Total and Pioneer Resources. I'm not super interested in oil stocks, and here's why. It's not because you can't trade them. It's because anything that's good for oil is better for solar, wind, batteries, and EVs even. So I know that I get some flack from a few people. Why aren't you trading oil? It's because, why do I need to? Why do I need to trade a downward secular trend that's on a rally when I can invest in things that have much, much brighter futures and longer term ramps up. They're both energy. Why not invest in the one that's trending up versus the one that's starting to trend down? If you look at the chart since 2014, it's not hard to see. All right, so who do I want to sell cash secured puts on? Well, the first company is AT&T, and I am outlining why and how in this article. And then I have a few more that I will show you, and we'll go through them all. AT&T, I will pull up Shooter's chart as well, and he can chime in when we get there.
Now, actually, the AT&T is one of two counts. That's the negative count.
Okay, well, we'll get there. So let me tell people why I want to invest in this.
Go for it.
First off, the AT&T valuation versus Verizon is underwater. So once they spin off Warner Brothers Discovery, they're going to have lower debt and a higher cash flow based on their existing businesses, which will be 5G and fiber and a handful of smaller things. But 5G and fiber are really going to be like 90 some odd % of their revenue. You also know about the catalysts that I see with them, which are what if they compete with Roku, which I think they will. Technologically, it's easy for them to do. And what if their deal with ASTS Space Mobile makes them into a global 5G play? Those two things are just massive catalysts, and they may or may not hit, but the trends are to the upside. The fiber is also a big deal because I think that everybody's going to have fiber to their home in the next 10 years, and almost every business is going to have it before that. So for the fiber that companies like AT&T and Comcast own are hugely, hugely profitable in the future. As you just saw, Amazon was able to raise the price of Prime at whatever it was, $20 a year. They're going to be able to raise the price of fiber pretty easily because there's an oligopoly. There's only limited players. 5G, a little bit more competition, but ultimately, I think you see consolidation on regional players into Dish and maybe even into AT&T. But I think really Dish is going to absorb maybe US Cellular or something. So the pricing in 5G isn't going to be going down anymore either. So if you got a good deal, be careful about getting rid of it. In any case, I asked Shooter what the heck this pattern is. So Shooter, what the heck is that pattern?
It's an ending diagonal down there.
It is. I got that right? All right.
You get too excited about that, man.
All right. All right. So here it is. It is an ending diagonal. See, people say I don't know what this is. I don't do Elliott Wave. Look, I did Elliott Wave 20 freaking years ago. Why? Because Prechter had this incredible hot streak just ending when I started to study all this. He was so hot from like 83 to 87 until the collapse. And I don't remember if he got the collapse right. I don't know if he got Black Friday right. But he is, he's a big deal as far as he recognizes that people operate in patterns, right? We're symmetrical. We love symmetry. And we just keep doing the same things right and wrong over and over and over again. It's just fascinating how the patterns work. And there's a limited amount of patterns because emotionally and intellectually we're limited. I'm not sure why, but a lot of these patterns are repeatable. So here's your ending diagonal. So explain this to the crowd in a way that is less technical. Just why
see where our C is next primary. Go over to your left. That's one. So it's a intermediate wave. Go to the one to the left of that, and then go up to the wave 2 up at the top of that. That's the broadening pattern in an ending diagonal there. It'll drop down. So there'll be a 3, 4, and 5 that forms a triangle to the downside.
So here.
Yeah.
Okay. Yeah. So you're saying the next primary wave long is at 2053. I'm saying 22-ish. So
it's in. I just put up a new chart. We have 2 counts depending on the time frame. That's the 90-minute look that you're looking at. Should be the last chart. I just threw it up.
Yeah. Okay.
That's a weekly scan. So that right now it's saying the weekly says the count's in, and the 90-minute says it's not. So that's part of when I'm talking about seeing a distortion in price.
Okay.
It's because it's recognizing different patterns based on the time frame, which is basically wave degrees. A primary wave. So that's the range. So there's a $2 range on that bottom.
Okay. So and that's fine there. So I was using a weekly chart and I came up with 22. So that's pretty freaking consistent. So the trade that I want folks to make is to sell the $23 March 18th puts for $1. They're only about 50 or 60 cents right now. So they have to set a good till limit order at $1. If you want to sell it for $2, go ahead. It might not strike, and might not you might not get the order filled. But if you can get a net price for AT&T of 22, I think you want to do it. The reason we're using, or that I'm using, these are all going to be March 18th puts, is that I want more of this stock, right? So like for me, AT&T is my only double position at a little over 8%. Really, it's almost a triple position, right? Because a normal position is 3 or 4%. So it's almost really a triple position for me. And the reason is I just am in love with the idea that AT&T is going to get revalued up to the Verizon valuation, which will send it to around 40. And B, I think that Warner Brothers Discovery is a 5 to 10x stock once it gets spun off. All right, so let's move on to Intel. Now, Intel, I think, is going to have a future very similar to this company. This is Taiwan Semiconductor. It's done all right the last 10 years. Why is that? It's because they became the main fabricator in the world for semiconductors. What is Intel moving into? Intel is about to become, if not the largest, the second largest fabricator in the world. The deals that you saw in Arizona last summer to build 2 new fabs, the expansion of their existing American fabs, and the deal in Ohio to build more fabs there and take advantage of the water situation, I think are pretty smart. Intel is about to take outsourced orders. I know that investors get very impatient with mergers and acquisitions, but most of the mergers and acquisitions actually work out after several years. Take a longer term look. You got to remember the other CEOs on the other side of those deals, they don't usually sell at a discount. So it takes some time to do the integrations. In Intel's case, Mobileye is starting to become a very good investment that they made a few years ago. And really all the other ones, they're washed out, right? They're out in the wash. So as this company, which is getting billions of dollars from the government, right? Government policies on their side, secular trend is on their side. Company's got a fortress balance sheet, right? So factor 1, secular trend on their side. Factor 2, government on their side. Factor 3, fortress balance sheet and leading technology. Ultimately, this consolidation in here, I think, is pretty clearly big time support. Now, could there be an event that drives it down into the 30s? For sure, it could happen. But I really want to sell cash secured puts, $44 March cash secured puts. I don't really even care what the premium is. Ask a little bit more than the ask. And if it falls down, go ahead and add it. Shooter has an Elliott Wave chart up in here somewhere. So here's this Elliott Wave. And so you're saying about $42?
Yep.
Yeah. When I model out the potential revenues here and the fact that the margins are pretty damn big and that we're going to need 5 times more semiconductors by the end of the decade, just like the cloud will be 5 times bigger. You take a look at this and honestly, I could see Intel being a $200 stock as well. I would say that for retired investors, this is maybe a top 3 stock to own. It pays a dividend. It's buying back shares. It's got mountains of money. The government's giving it more. And now all the semiconductor companies that are building, they need to create semiconductors for cars, servers, and freaking satellites. They're all going to come here. And who knows what happens with Taiwan Semiconductor. I actually think there's a potential that if China really ever does go hardcore after Taiwan, that company, gets cut in half, that it falls apart. The Asian part stays Asia and then the American company comes here. So if Taiwan Semiconductor gets super cheap on an event, we'll look at that too. They also pay a small dividend. But I think Intel is the one where we're going to see dividend growth. We're going to see share buybacks and a massive expansion of demand. Did you model this out, Shooter, to the next wave, 5 waves up?
I can't see it yet on an ABC or a flat.
Okay.
I mean, I can, it'll take me 15 minutes to do it manually, but I would assume 3X from the base. So you can look at maybe 120 on the high side around 2025.
Okay.
I mean, just looking at equality off of that ABC.
Gotcha. So anywhere from 120 to 200 is what we're seeing then. I think fundamentally I think we probably really shoot through, but we'll see. We'll see. Another stock that I want you to take a look at. So these two are both on the plug and play. Is Unilever. Why Unilever? One, it'll give you some international exposure. It's under pressure right now, but it falls into the whole cannabis theme. So they have made a pretty good push into cannabis, in addition to all their other sins. So I think that Unilever, for most of you, would fall in your range. There's not a ton of premium here, so we're gonna have to use a good till cancel limit order, and I'll put that in the article. But as it gets into the box here, and I think, again, the next time the dollar rises, which I think is probably next month, you see this come down in here. Shooter has a shorter term chart for this. So he's saying next primary wave at 46.
Actually, it's in. The count's in. That is a prior low. I didn't label it correctly. Sorry.
Okay, well, so we're either there or about to get there. I think you can be conservative on this one. If you sell, say, a 47.50, even a $50 put right in here, I'll give you a couple of different choices. Set some limit orders, and if it gets hit, it gets hit. And if it doesn't, it doesn't. We're already buying the cannabis ETF, so I don't think this is something you have to have, but I think that if you want international exposure and a good dividend with a staple stock, essentially, you're good with SIN. This is probably one that we get a net cost in here. I think it's a bargain. So I just can't see it getting back down in here. Over here on the left, I know I don't talk about these all the time, but I use them extensively. Right here there's like no selling pressure. So if it would sell down to about this area, the selling pressure pretty much goes away. And there's huge support down here. So lower 40s is about as low as I can see it getting. Next on the list is New Fortress Energy, which is my guy who brought me a NBA championship. That's who owns this, or is the major player here. You can see it's getting down to a point where there's not a lot of selling pressure anymore. So it is, in fact, bottoming right where we'd expect it to bottom. Why do you like this company? One, they pay a dividend. They are a little bit highly levered. So if the price of natural gas would collapse and LNG would dry up, that would be bad for these guys. This is an LNG company, and they're operating a type of rig that's unique. The rig can move to fill ships. So they have something that really is fairly unique to them. I think there's two other companies that can do it. One's in Asia, and they're operating mainly in the Caribbean, and also they're selling LNG to Europe. So this has spike potential. I don't think there's much downside. And if we get a disruption in the Middle East or from Russia with Europe, you could see this one come all the way back up here to 50 something pretty quickly. So at a minimum, I think selling a cash secured put where you get a net price in the middle teens and maybe taking a starter position as well is one of those low risk, high reward opportunities. So I would probably say this is a classic case of starter position and sell a put. Let's take a look at Shooter. Next primary long, 1450 Shooter.
Yep.
So what happens if there is an oil or a natural gas shock of some sort?
It's probably going to retrace 50% of that B, so 30.
So jump right back up here.
Yeah, I doubt that it'll get above the 8-day, but it'll definitely hit the 30.
Okay.
And it really depends on how big that spike is, because we could actually see a spike. I saw some graphs on it up to 120 WTI. So that, it depends on if they start blowing things up.
Right. Well, so there's natural gas coming on the market, and obviously there's the weather impacts trading in the short term. My broad thesis on natural gas is this. I think that natural gas is going to be a pretty strong play into the 2030s. Why? First off, we know that associated natural gas from oil drilling is going to fall. And that means that we have to get natural gas from other places if we want it to help replace coal along with solar and wind. We also know that there has to be enough natural gas out there for geopolitical reasons to keep countries like Russia from invading Ukraine. The argument that a lot of people make on oil is the one that I make on natural gas. And it's the one that I've been making for, going on 10 years now. I think natural gas has a nice long ramp into the middle to late 2030s, whereas oil, their ramp is into the middle to late 2020. And, I don't want to play in that sandbox. But here, I think that we will also see natural gas prices go up a bit in the long run. And that is good for certain companies, including the pipeline companies, which means that they're being de-risked, and also the companies that transport, because demand will be pretty good. Ultimately, that falls off, but I don't think it's in the next 10 years. I mean, I guess it could be if something weird technologically happened, but if you're going to play in fossil fuels, I think this is the place to go. Now, with any fossil fuel play, I want a backdoor, and the backdoor on New Fortress is they are actively pursuing hydrogen. And I believe that blue hydrogen, which is basically what's being used now, will transform into green hydrogen, and these guys have a process for that too. So this is a company that's not just a natural gas play, but it has that second catalyst, right? I always like to stack my catalysts. It also has the backup play on hydrogen. So it has the ability to spike higher, doesn't have a lot of downside, and it has an even longer term ramp beyond the ramp for natural gas. But it is a little bit delicate financially, so it can be extra volatile. Shooter, anything else on this one?
Now, that's pretty cut and dry. I mean, it'll just be a slow bleed with that look.
So just sell the put, so we get a net cost around 14.15. Okay. And then the other one is Atlantica Sustainable Infrastructure. It used to be Atlantica Yield, symbol AY. We're getting a consolidation here. I haven't looked at Shooter's chart yet. I'm guessing his Elliott Wave is going to be in my box. So let's take a look. Company pumps out a good dividend. Next wave says 29.47, right around the 200-day, 27-ish. Yeah, about the same. Okay. So again, I'm using the quant factors. It's harder on this one because it's lower volume and you can't really tell. I think that there is a possibility if there's a broader alternative energy sell-off, it could go into this Armageddon pricing level, in which case back up the truck if it gets down towards 20. But I think mid-20s is probably the price. I like what Shooter's showing here. I think that we have puts because the premiums are a little higher, although it's thinly traded. But I think in energy in general, you get pretty good premiums. So when you can sell options, when you can sell puts at the bottom of a cycle, even a shorter term cycle, probably going to do pretty good. Because why? Because energy is cyclical. It's always going to come back to you. So if you sell closer to the peaks and buy closer to the bottoms, you don't even have to be precise as long as you're fairly accurate. And I think that this wave here, I think the upside here is just to grind higher. I don't think this has the explosive upside because of the nature of the business, right? It's very project dependent. It's not commodity dependent. And they are having projects drop down to them from, I believe, Algonquin. But the deals usually come with a pretty set and known margin structure. And they're projecting out 5 to 6% dividend growth over time, as well as just general 5 to 6% growth. So again, this one is easy to trade from a fundamental standpoint because you just have to decide, well, what am I willing to get? Well, if you sell the puts, you're going to get 3 or 4% is what I saw on top of the dividend yield. And you can really make this, to me, this is the closest one I think we have to a bond substitute. It's not a bond, right? It doesn't come with those protections. However, if you get it at the right price, it's something that you just buy it on the low cycle, sell it on the high cycle, and keep an eye on any additional deals they get that are attractive or that aren't as attractive as they should be. So these yield companies occasionally make a bad deal. You got to keep an eye on them for making bad deals. Sometimes that comes from the incest between the company that spun them out or created them. So you have to make sure they're not getting screwed on parent company or related party deals. But in general, you buy these cheap enough. If you're looking for an 8, 9, 10% net effective yield premium plus dividend, I think that you can get it if you get this down here. All right. Any questions on these 5 stocks? Well, apparently we explained that pretty well, Shooter. Anything that you like to add? Anything you got, Scott?
Nothing specific. I mean, we're just sort of stuck in between here. I mean, as far as indices, outside of that, I'm sort of sitting on my hands because I don't like the either side. Maybe a couple plays into earnings here, but I haven't even got excited about those yet. So
okay. All right. So here's what's coming this week. I'm going to put out a pretty extensive stocks of the week pulling the earnings reports from Centio, and I'm also going to have that Ametis interview up finally, probably Wednesday afternoon, along with an article. And here's something you should know about Ametis. BlackRock just bought 9% of the company. So the institutions are coming. I'm going to also sell a cash secured put on Ametis, but I'm also going to take a starter position. They're up 10% today. So you get a little breather. And this is where I think, Shooter, maybe you can give us kind of a short-term outlook on this one. How low can we get it back again? But I believe that we're seeing the pivot up. We'll get some jitterbugging. You want to try to buy the down parts of that jitterbug and sell cash secured puts. And I'm going to put this article and the podcast on Seeking Alpha next week. So you're going to start to see more people at least know who this is. I've only whispered about it so far. I buried it in another article, but this is going to be a primary ticker. 70,000 people see it. So I would sell your puts this week on Ametis. We will get a chart up for that. I'll do a whole separate article on that one. And I think you should have a starter position. If you don't have a starter position, I really think, we get this back under $10 sometime this week. You're going to want to add to it. It's got upside to $50 plus. Why? Because their projected revenue at Ametis 4 years out is about $5 billion. And that's not pie in the sky. They have deals with Delta, with American Airlines, and it looks like it's with Travel America, but it could be Pilot. If it's Pilot, that's Berkshire Hathaway is getting bed with them. And they just cut a deal with SunPower for the microgrid that's going to power their new plant. If you saw in December, they finally finalized the deal for that 125 acres where they're going to do carbon capture and clean biodiesel, and they're going to run that on a microgrid from SunPower. So SunPower is another one that we should really be paying attention to. As I told you, SunPower might end up being the number one company in America for microgrids. And microgrids are going to end up freaking everywhere. They're going to be in industrial parks everywhere, and they're going to end up in new condo developments all over the country. So keep that in mind. You're looking at huge, huge markets as this energy transition progresses over the rest of this decade. All right, have a great day, everybody. I am going to take a couple phone calls and then go get my car looked at, and then hopefully take the rest of the night off. Tomorrow I'm doing a half day. Gonna have some lunch with one of my grandmothers who's still kicking at 94 years old. She's getting a Culver's burger with fried onions, ketchup, and a strawberry malt. All right, everybody, have a great rest of the day and more coming.